Hi, welcome to part 1 of the notes to the consolidated financial statements. We will start with Note 1, Summary of Significant Accounting Policies. This note is a required disclosure which includes all of the significant accounting policies that management has selected for Apple's financial statements. Here, we will see that there is a mention to the consolidated financial statements. As mentioned earlier, this includes all of the wholly owned subsidiaries that fall under the parent company of Apple Inc. The next item I want to highlight is the reference to US GAAP. This is the accounting framework that Apple is reporting under. Reporting frameworks include US GAAP and IFRS. In this portion of the paragraph, we will see a reference to reclassifications. This is common where the comparative periods may be reclassified in order to make it consistent with the current year presentation. The reasons companies do this is done in order to allow the current year to be accurately compared to the prior year results. The bottom half of this page refers to the recently adopted accounting pronouncements by Apple. This section includes and summarizes briefly the change in the accounting guidance, as well as management's conclusion on the impact of the change. For example, whether the change had or did not have a material impact on the financial statements. The next note to the financial statements is Note 2, Revenue Recognition. This, in my opinion, is one of the most significant policies and notes in the financial statements. The policy here outlines the company has a direct impact on when they recognize their revenues and income on the P&L or the profit and loss statement. In this case, revenue is recognized when control is transferred to the customer, for example, when Apple's products are shipped. The next item to highlight here is the section on product returns. For instance, when recognizing the revenues, the company will also need to make a best estimate and provide a reserve for the product returns. This reserve is netted against the sales in the P&L, hence why it is called net sales. Here, we can see that there is a reference to performance obligations. This specifies the performance obligations that needs to be met in order to properly record revenues on the books. For example, there can be a single performance obligation for simple transactions or multiple obligations depending on the product or service. Specifically in Apple's case, we can see that in order to meet the revenue recognition criteria, they have 3 performance obligations for their hardware, such as the iPhone, Mac, and iPad. The next page is a continuation of Note 2. Here, we can see that there is a section on disaggregated revenues. This table provides the breakdown by the key product or service. Based on a quick observation of this table, we can clearly see that the iPhones represents a significant portion of Apple's sales and is in fact more than 50% of Apple's total net sales as a company. What's more interesting is when you look at the numbers, we can see some trends in this section of the table. For iPhones, we can see that sales have decreased year over year from 2018 to 2019. Specifically, revenues went down from $164.9 billion in 2018 to 142.4 billion in 2019. In contrast, for Mac, sales for Mac are flat at around $25 billion over the last 3 years. For its iPad product line, we can see that iPad sales were flat from 2017 and 2019. However, we can see that there is growth in 2019 for iPads. In contrast, for the wearables, home, and accessories category, we can see that there is significant growth in the segment. For example, there was $17.4 billion in 2018 versus $24.5 billion in 2019. Similarly, for services, we can see that there is also significant growth in this category and the services line item, where this increased from $39.7 billion in fiscal 2018 to $46.3 billion in fiscal 2019. The last item to note on this page are the footnotes. These detailed footnotes provide the details of what is included under each category in the aforementioned table above. For example, we can see that sales from the Apple Watch are not in a separate category, but is in fact included as part of the wearables, home, and accessories line item. Welcome back. This is part 2 of the notes to the consolidated financial statements. Starting with Note 3, Financial Instruments, we can see that the table includes short-term and long-term securities. So Apple classifies its marketable debt securities as either short-term or long-term based on each instrument's underlying contractual maturity date. Short-term marketable securities typically have maturity dates of less than 12 months. Another way of looking at this is these are highly liquid and can be converted to cash relatively quickly. For Apple, this includes their holdings in their money market funds. In contrast, long-term marketable securities typically have maturity dates greater than 12 months or more than a year. As we can see, out of the total $205 billion of cash equivalents, and marketable securities held by Apple, a large portion, or $105.4 billion, are held in a long-term position. Unrealized gains and losses. So we also see columns for the unrealized portion. And the key takeaway for this is that unrealized gains and losses on marketable debt securities classified as available for sale are recognized in other comprehensive income or loss, or the OCI statement. This is because the marketable securities have been classified and accounted for by Apple as available for sale. In simple terms, what this means is that the fluctuations in the fair value of the marketable securities of these investments are not directly impacting net income in the profit and loss statement that we saw earlier, but instead it goes through the OCI statement. Here, we also see level 1 and level 2 inputs. So what are level 1 and level 2 inputs? Well, level 1 means that these are quoted prices. These were obtained from an active market for identical assets or liabilities that the entity can access the measurement. In simple terms, these are values that are unadjusted prices from the market, and it's a highly reliable fair value. In contrast, level 2, these are inputs other than those quoted prices included within level 1 that are observable for the asset or liability, either directly or indirectly. In simple terms, these are not quoted prices that we've seen in level 1. And here we can see the types of securities held by Apple. So going back, we can see level 1, they're holding money market funds, and level 2, they hold different types of instruments such as treasury securities, non-US government securities, some commercial paper, some corporate debt securities, along with about $14.2 billion of mortgage and asset-backed securities. The key point here is that we can see the largest portion, 85.4 billion, are held in corporate debt securities. And following that, the second largest balance or its investment of 30.3 billion is invested in US Treasury securities. The next part we have is Note 4, the consolidated financial statement details. Here we see the details for PP&E, or property, plant, and equipment. This table shows us the composition of assets included within PP&E and includes items such as land, building, machinery, equipment, and leasehold improvements. The balance includes internal use software as well. Note that PP&E is not fair valued, but instead, the balance is the original cost of the asset less accumulated depreciation. Here we see a line item for the accumulated depreciation and amortization. So depreciation on PP&E is recognized on a straight line basis over the estimated useful lives of the assets. So as an example for Apple, buildings are amortized over the lesser of 30 years or the remaining life of the underlying building. In contrast, machinery and equipment, which are expected to have shorter lifespans, those are typically depreciated between a period of 1 and 5 years. Capitalized costs related to internal use software, those are amortized on a straight line basis, and those range between 3 to 5 years. Moving over to the bottom section, we can see other non-current liabilities. And here we see long-term taxes payable, which comprises 29.5 billion of the 50.5 billion of other non-current liabilities. These are essentially the taxes that Apple needs to pay in the future. The main point is that a significant portion of the other non-current liabilities relates to taxes payable from the company. As we will see in the other notes to the financial statements, Apple is liable for federal taxes, state taxes, and foreign taxes. Here, under other income and expenses net, we see a line item for interest and dividend income. So this is the interest and dividends Apple would have received from its investments, such as its marketable securities. We can see that although Apple received 4.9 billion in interest and dividend income, that amount is relatively small relative to the balance of its total marketable securities and cash balance. Then offsetting this amount is interest expense. This reflects the interest expense Apple would have paid during the year on its loans, such as for its term debt or its commercial paper. And here we can see that approximated $3.6 billion for 2019. Welcome back. In this lecture, we will go through the notes to the Consolidated Financial Statements, Part 3. We'll first start with Note 5, the income tax note. Here, we can see a paragraph which highlights the US tax cuts and Jobs Acts. The key point on the slide is that tax reforms has a direct impact on Apple's tax exposure and liabilities. In the table, we can see section for federal, state, and foreign taxes. Here we've highlighted the federal and state taxes, and the key concept is that since Apple Inc.'s parent company operates in the United States, it is subject to both federal and state taxes in the US. The next part of the table are foreign taxes. This is because Apple operates globally, with many of its subsidiaries in foreign markets, and as such, it is exposed to foreign taxes. One comment I want to highlight here is that although Apple has a significant cash reserve balance, so cash, cash equivalents, and marketable securities on its balance sheet, the reason it does not use a large part of that cash or marketable securities is because it would be subject to taxes if it was to repatriate or move the cash back to the United States. The next part we see here is note 6 of the notes, which is the debt section. Commercial paper. What are commercial papers? So this is a type of unsecured short-term debt instruments issued by a company. In Apple's case, they have a commercial paper program which allows them to issue these unsecured short-term promissory notes, also known as commercial paper. Maturity dates for the commercial paper is mostly less than 9 months for Apple. Weighted average interest rates. You can see that the weighted average interest rates for Apple's commercial paper was 2.24% and 2.18% as of September 28, 2019. Another way of looking at this is that in order to borrow this cash, Apple had to pay interest of a little over 2% to get this financing. We can see that there is 3 years of comparative balances. The rationale for this is that since this table highlights the proceeds and repayments activity of the commercial paper program, this table includes 3 years of information, similar to the profit and loss statement, P&L, and the cash flow statement. The first part of the table includes those maturities 90 days or less. We can see that the net repayments in 2019 was $3.2 billion for those maturing less than 90 days. The bottom part of the table, we can see those maturities that was greater than 90 days. We can see net repayments of $2.7 billion in 2019. This next slide is a continuation of the debt note. Here we can see the term debt. A term debt is a loan which is issued by a bank for a fixed amount and fixed repayment schedule. These loans can either be fixed or have a floating interest rate. So what is a floating interest rate? A floating interest rate is a variable interest rate on a loan that fluctuates over time. The rate fluctuates since it is based on an underlying benchmark interest rate or index. Note this is also commonly referred to as the adjustable rate or just floating rate loans. There are also fixed rate. This is the interest rate that is fixed for the term of the loan. It's exactly what it sounds like. The rate does not move based on any benchmark interest rate or index. The key point I want to highlight is that companies usually look for a combination of both variable and fixed rate loans in their portfolio. In this table, we can see there are columns to highlight the effective interest rates and the ranges for those rates. So what is effective interest rate? Well, this is a finance term or concept. And a simple way of looking at this is the real percentage interest rate when the effects of compounding over time are taken into account. In other words, it reflects a truer picture of the interest rate because it factors in compounding from the periodic payments. As you know, payments can be made on a monthly basis, semi-monthly basis, or even an annual basis. In Apple's case, we can see the range of fixed rate loans are wider, ranging from 0.28% to 4.78% in 2019. In contrast, the floating rates are hovering around 2.25% and 3.28% based on the current market interest rate plus its spread. Here is the floating interest rate, and here is the fixed rate. The last part of this table is the interest rate swaps and foreign currency swaps. We will actually discuss this in further details on what these terms mean and what its purpose is in future lectures. Welcome back to the notes to the consolidated financial statements. This is part 4. We'll start with note 7, the note relating to the shareholders' equity. Here we can see a note and paragraph for the share repurchase program, also known as stock buybacks. This program was approved and authorized by the board of directors of Apple. Essentially, what this allows is for Apple to buy back its own shares from the market. As an example, we can see that Apple's closing number of shares decreased from 4.7 billion in December 31, 2018 to 4.4 billion as at December 31st, 2019. So why would a company perform an arrangement such as this? Well, typically, the purpose of a buyback is due to a company believing that their share price is undervalued. When the company does this, it results in a lower outstanding number of shares floating in the open market. As a result, this changes the per unit amount in the calculation. As we've learned earlier, EPS would be calculated as, let's say, the net income divided by the basic number of outstanding shares. So going back to Apple's balance sheet that we saw earlier, we can see that the shares used in computing earnings per share, which would be a weighted average calculation, decreased from 5 billion shares in 2018 to 4.6 billion shares in 2019. This part of the table, we can see the common stock repurchased and common stock reissued or issued by Apple. So, issuance of common stock includes 33.5 million shares that Apple issued during the period. For instance, this includes the issuance of shares that Apple would have completed for its employee benefit plans. The next note in this section is Note 8, Comprehensive Income. First part to highlight here is the functional currency. So functional currency refers to the main currency used by a company or a business or a unit of business. It is the monetary unit of account of the principal economic environment in which an economic entity operates. Note that this is different than reporting currency, which is the currency that the financial statements are prepared in. For example, in Apple's case, this would be in USD or US dollars. Here on the table, we can see the unrealized gain, losses on derivative instruments. What is a derivative instrument? A derivative is a contract between two or more parties whose value is based on an agreed upon underlying financial asset, index, or security. Examples of a derivative instrument includes futures contracts, forward contracts, options, and swaps. The key point is that derivatives are used by companies in order to mitigate risk, which is also known as hedging. In Apple's case, they enter into foreign exchange contracts, also known as FX contracts, and interest rate contracts. An example of that would be interest rate swaps, in order to quote unquote hedge their risks. So foreign exchange contracts, what are these? This is a contract where there is an agreement between two parties to exchange two designated currencies at a specific time in the future. The idea is that the foreign exchange contract is a hedge against risk and provides protection to Apple from unexpected movement in the foreign currencies. Next part we see is a portion on interest rate contracts. So interest rate contracts includes interest rate swaps. These are essentially a financial contract whose value is based on some underlying interest rate. Key point is the purpose is to use this derivative to hedge, or in other words, minimize potential losses resulting from a change in the fluctuations in interest rates. Overall, the key takeaway for this table is we can see the impact of foreign exchange contracts and interest rate contracts and its impact on other comprehensive income, or OCI. In this lecture, we will continue with the notes to the consolidated financial statements. First note we see in this section is note 9, the benefit plans. So this is a stock plan. So why would Apple have an employee stock plan? Well, typically companies would have an employee stock plan in order to attract and retain valuable employees, in order to motivate those employees to work harder, to increase the value of the company, along by increasing its overall stock price. Another purpose of employee stock plans is it's actually a good mechanism for a company to save its cash. By issuing stock plans, it's not necessarily paying out a cash amount to its employees. But more importantly, the real purpose is to align the financial interests of the employees with those of the shareholders. So for example, Apple's restricted stock units, or RSUs, granted under their 2014 plan generally vest over 4 years. Another way of looking at this is in order to receive the full benefit of these units, it needs to vest. And in order for it to vest over 4 years and for the employee to gain that benefit, the employee needs to have continued employment with Apple over this vesting period. So what is a vesting period? In simple terms, a vesting period is the period of time in which the employee must work for an employer or for a company in order to obtain or earn those shares. The next note we see is note 10, commitments and contingencies. Here in this table, we can see the warranty provisions, the costs and accruals related to the warranty program. This reflects that accrual that Apple has made on its books relating to its warranties. on its products. This table effectively rolls the opening balance, backs out the actual costs incurred during the year, and then adds any additional accruals or best estimates the company feels they need to add to this accrual balance. In total, we can see that Apple has accrued on the books approximately $3.5 billion relating to warranty provisions. We also have an iPhone upgrade program mentioned in the paragraph below the table. This is an interesting paragraph because this is something many of us are familiar with. In essence, the iPhone upgrade program allows customers to trade in their used iPhones for a specific dollar amount when buying a new iPhone. And as such, you can see the impact that this type of program would have on its warranties and guarantees for the company. The section below goes through the concentrations and the available sources of supply of materials and products. I look at this as supply risk. For instance, this section highlights that almost all of the hardware from Apple are outsourced and manufactured in countries located in Asia, for example, in China. This is because when events happen, such as COVID-19, this actually puts the supply chain under pressure and creates a risk for Apple and the company in terms of being able to have In this section, we'll go through the notes to the consolidated financial statements, part 6. Here we see Note 11, segment information and geographic data. We can see the reportable segments is based on geographic basis. So what is a reportable segment or an operating segment? Well, an operating segment is a component of an entity that engages in business activities from which it may earn revenues and incur expenses, and B, whose operating results are regularly reviewed by the entity's chief operating decision maker, or CODM, to make decisions about resources to be allocated to the segment and assess its performance, and C, for which discrete financial information is available. So once those three criteria are met, then you can report on a segment. So in Apple's case, management views this on a geographic basis. We can see here that there's comparative information, which is for 3 years, similar to the profit and loss